There is a quiet economic shift happening across most developed countries, and unlike a financial crisis or a stock market collapse, it doesn't announce itself loudly. It doesn't dominate headlines every day, and it doesn't feel dramatic in a single moment. But over time, it changes the entire trajectory of a generation. For the first time in modern economic history, there is a serious possibility that young adults entering the workforce today may end up with lower lifetime wealth accumulation than their parents did. This is not a minor claim. For decades, economic progress followed a predictable pattern. Each generation earned more, owned more, and accumulated more assets than the one before it. That expectation became embedded in culture, education, and even politics. So what has changed today, and why so many young people, despite being more educated than previous generations, feel economically stuck? And is this perception exaggerated, or is it something structural actually shifting? If you compare median wages adjusted for inflation across multiple advanced economies, you'll notice something unusual. Wage growth for young workers has slowed dramatically relative to productive growth. In simple terms, economies became more productive over the past 40 years, but the share of income going to labor, especially entry-level labor, did not rise proportionally. That raises an immediate question: where did the gains go? The answer lies in asset ownership. Over the past several decades, capital assets, particularly real estate and equities, appreciated significantly faster than wages. If your parents bought a home in 1990s or early 2000s, they were purchasing into a housing market that had not yet experienced the same degree of global capital inflows. Today, in many major cities, the price-to-income ratio for housing is dramatically higher than it was for previous generations at the same age. This means young adults are not just facing high prices, they are facing prices that have detached from wage growth. And here is the deeper structural issue. When asset inflation outpaces wage inflation for decades, wealth accumulates disproportionately among those who already own assets. So the generational divide is not simply about income, it's about ownership. For decades, higher education was presented as a pathway to upward mobility. And statistically, degree holders still earn more on average than non-degree holders. But the context has changed. Tuition costs increased dramatically in many countries, especially in the United States. Student debt burden expanded at the same time that the entry-level job security declined. This creates a delayed wealth accumulation effect. Now, previous generations entered adulthood with little or no debt and purchased homes early. Today's graduates often begin their economic lives servicing debts for years before even considering asset acquisition. This compound effect of delayed investing is rarely discussed. When wealth accumulation is pushed back by 5 to 10 years, the long-term impacts on retirement savings and asset growth become substantial. This delay alone can reduce lifetime net worth significantly. And yet, culturally, this shift is rarely framed as structural. It is often framed as personal responsibility. Housing is often discussed as a supply issue, and supply constraints are real, but that is only part of the story. Low interest rate environments following the 2008 financial crisis and again after COVID-19 created conditions where asset prices inflated rapidly. When central banks lowered interest rates, borrowing becomes cheaper. Cheap borrowing increases demand for assets like housing and stocks. Those who already own these assets benefit. Those trying to enter the market later face higher barriers. This is not accidental. It's a feature of monetary policy designed to stabilize economies during crisis. But over time, repeated monetary expansion can widen generational wealth gaps. And here is where geopolitics subtly enters the picture. After COVID-19, governments injected massive fiscal stimulus into economies to prevent collapse. That money had to go somewhere, and large portion flowed into financial markets and real estate. So when young people say everything feels unaffordable, they're not imagining it. They are competing in markets shaped by extraordinary monetary policy. Previous generations often entered long-term employment contracts with predictable career progression. Today's labor market is more flexible, more digital, and more global. Flexibility has advantages, but it also shifts risk from institutions to individuals. Gig economy platforms, short-term contracts, freelance agreements, and algorithm-driven employment reduces stability. When income becomes volatile, it becomes harder to secure loans, harder to plan long-term investments, and harder to take financial risks like starting a business. So even if headline unemployment rates appear stable, the quality of employment may differ significantly from past decades. That difference compounds over time. Globalization expanded supply chains and reduced production costs. Consumer benefited from cheaper goods, but labor markets became globally competitive. Manufacturing jobs that once supported middle-class stability in Western economies shifted overseas. Service sector expansion replaced some of those jobs, but wage growth dynamics changed. This does not mean globalization was purely negative, it lifted millions out of poverty globally. But within developed countries, it altered bargaining power dynamics between labor and capital. Now let's talk about the rise of AI and automation. Artificial intelligence and automation introduce uncertainty about future labor markets. Every technological revolution creates disruptions, but the speed of AI advancement raises new questions about mid-skill job displacement. Even if AI increases productivity, who captures that productivity gain? If ownership of AI systems remain concentrated, the income distribution effects may amplify existing wealth gaps. So the question becomes, are we entering an era where capital earns more than labor at an accelerating pace? If so, generational wealth accumulation patterns could shift further. Many developed countries are experiencing aging population. Fewer young workers support more retirees. This creates fiscal pressure on pension systems and public spending. Younger generations today may face higher taxation burdens to maintain social systems built during demographic booms. So, they are entering adulthood during a period of higher public debt, higher housing prices, and slow real wage growth. That combination is historically unusual. So here's the final question. Is generational decline inevitable? Well, not necessarily. Economic systems evolve, policies can change. Housing supply reforms, education for cost restructuring, labor market adaptation, tax policy shifts, and technology could alter outcomes. But structural shifts rarely reverse automatically. They require deliberate political and economic adjustments, and that is where public awareness matters. The idea that each generation will automatically live better than the previous one is not a law of nature. It was a product of specific historical conditions: industrial expansion, demographic growth, affordable asset entry, and post-war economic policy frameworks. Those conditions have changed. That does not mean young people are doomed. But it does mean that the path to wealth accumulation looks different, and in many ways more challenging than it did for their parents. So we want to ask you something. Do you think this is a temporary economic cycle, or are we witnessing a structural shift in generational wealth dynamics? Write your thoughts in the comments down below. If you found this analysis valuable, support the channel by subscribing and leaving a like. It helps more than you might think, and it allows us to keep producing in-depth, research-driven content. In the next episodes of this series, we will explore the global housing crisis in much greater detail, not just from a pricing perspective, but from a structural, financial architecture perspective. Because once you understand how housing markets really function, you start to see why affordability has changed so dramatically. Until then, stay curious and stay informed. Thanks for watching.